Hi everyone, I'm Ricardo Gonçalves. This is SBS On The Money for this Monday, the 22nd of February 2021. It's your daily 10-minute business and finance news wrap. Later, the Australian dollar has hit a fresh 3-year high. We'll tell you why in a few moments. But first, to the Bank of Queensland, which has agreed to pay $1.3 billion to buy Me Bank. It effectively doubles its retail business, which includes mortgages, and will create an organisation with more than $88 billion of assets. So for more, I spoke earlier with the CEO of Bank of Queensland, George Frazis. George, how big will your bank be following this acquisition, and just how important is scale in this current environment?
Ricardo, this is a very exciting day for the BOQ Group. The acquisition of Me Bank effectively doubles our retail bank, so it is quite significant. But what's really important is that there's very little overlap with the three brands that we operate, which is Me Bank, BOQ and Virgin Money. So that makes it quite exciting. And then the second really critical thing about this acquisition is that we're all on a common Terminus core banking platform, and we're able to then migrate to the leading cloud-based digital platform that really will create real advantage for our customers.
So how does this make you a better rival to the big four banks?
Well, the starting point is that each of those brands resonate with different customer segments, and they're very customer focused. So this is all about providing a credible, real customer focused, trusted alternative to the majors. But if you then think through what our end state, which is a cloud-based Terminus state-of-the-art core banking platform, all three brands will migrate to that. And then what that means is that we can leverage Terminus's global investment in innovation and provide those services to all of our three brands and the customers through our brands.
Okay, so you're mentioning technology there, which is one key turnaround project that you've been working on. So how do you go through this digital transformation, integrating this new large business, and still navigate COVID-19 at the same time? Are you up to the challenge?
So, Ricardo, the backdrop of this is that we've just presented highlights of our half-year results. So the business is going really strongly. So we're performing, we're growing ahead of system, we're improving our service, and we've improved our business now over 3 halves. So the strategy is working. Our end state strategy does not change. So it is all about being customer focused, about retail banking and small business banking. And then also our technology strategy doesn't change as well. So Me Bank really fits in nicely with that because we've got common core platforms, because culturally we're very aligned. This is really exciting for the BOQ Group.
Just a couple of quick questions on the economy, right? We're starting to see vaccines roll out as of today. To what extent are you an optimist about the economic recovery? And are there any key risks that you're worried about out there?
Ricardo, we're quite bullish in terms of the opportunity in Australia. And I'll have to say, full credit to the federal and state governments. They've handled this crisis extremely well. And, there's no doubt we're into a recovery. It will be a bumpy ride. There's still some uncertainty over the next 8 months or so. But, the start of the vaccine is really promising. We're seeing improvements in unemployment. House prices are, if anything, increasing. So there's a stabilization of the economy, which is encouraging. The other thing I would state is, we're big on small business at BOQ, and we're starting to see each of our specialized small business segments coming back and investing with a bit of confidence, which is really encouraging.
And just finally, when you look at those numbers out of small businesses, and then when you take into consideration the home loan deferrals that you're seeing as well, does it give you confidence about the way the economy can come out once JobKeeper ends, or do you think we still need some form of JobKeeper?
Ricardo, it's a very good point. As you know, all banks, including BOQ, really supported our customers, both home loan and small business customers, through this. What we've seen is quite a material drop in the number of customers that require that deferral. They're both now under 1%. In fact, our small businesses are down to 0.7% requiring deferrals, and our home loans are down to 0.6%. So you can see that our customers now are getting back on their feet. and slowly getting back to some version of normal. Without a doubt, a broadly based vaccine is going to add to that confidence.
George Frazis there, the CEO of Bank of Queensland. To the Australian share market now, which fell 0.2% on the S&P ASX 200 to 6,780 points. Vaccine optimism drove travel stocks, so the likes of Webjet rose 13%, corporate travel management up 8%, Qantas added around 3 to 4%. A profit upgrade helped Macquarie to make some good gains today, but we saw some pretty heavy selling in the banks and some of the blue chips like CSL, which pushed the market into the red. For more on that, and for more on where the market is going, I spoke earlier with Perpetual's Matt Sherwood. Matt, the market didn't do much today, but it comes after a really strong lead up into the end of the year. What do you make of it, and how much has that got to do with earnings expectations?
Well, probably the market's in a consolidation phase at the moment. So we had a very big run up, as you said, in the second half of last year. And nowadays we're getting kind of more down days than we did, for example, 2 months ago. But I tend to think, the market rise is starting to flatten out a little bit because, whilst we have much higher earnings expectations, as you say, stronger growth also does come at the cost of higher bond yields. And of course, higher bond yields weighs on valuations. But in many ways, the improvements we're seeing in earnings being partially offset by valuations, that's just what you see at the start of every cycle. And it means that, even though we're probably going to get global earnings growth this year of around 30%, investment returns for the patient people out there may be only half that. And their question is really, well, how do I manage that risk?
Speaking of patient, right, we saw travel stocks doing really well today on the back of vaccine optimism, which just started rolling out in Australia. Are investors right to be optimistic about the path out of COVID, or are there some real risks there still?
It's probably a combination of both. I believe that at least in the short term, the critical drivers for the 2021 outlook is the path of the virus, stimulus, and the distribution of the vaccine. And most people would know that recently case numbers have been coming down fairly aggressively, and the logistic issues around the vaccines are now being resolved. And of course, that's allowing an earlier relaxation of mobility restrictions, which is really good for the growth outlook. Now, of course, the lockdowns in 2020 forced a fairly aggressive mutation of the virus. And a key question more over the long term is that whether, the virus mutations into the South African and the Brazilian strains, which are making the vaccine less effective, whether that's more of a long-term issue for the extent of reopening we can actually get in the economy. My suspicion, for what it's worth, is we can't eradicate the virus, but we can demote it to being something like the flu. But whether or not that leads to more or less lockdowns and market volatility over the long term at this stage is anyone's guess.
So putting that into context and everything else, what are the 3 key risks that you see at the moment? What are you concerned about?
Well, probably the thing that worries me the most, at least in the near term, is the market's focus. We're getting a lot of bubble-like signs in the United States, for example, in the technology sector. So it feels like in many ways history is repeating itself. Small cap companies which have no earnings are doubling and quadrupling on the first day of trading. And even at the large cap end of the spectrum, Tesla now is the 4th largest company in the world. And it's currently trading at, a price earnings ratio of over 1,000 times earnings. And I don't think it's a particular brave call to say that those sort of valuations and tech performance really aren't sustainable over the long term. So that's probably what worries me the most. And other things that do, just have me a little bit cautious at the moment is the impact we're seeing of rising interest rates, particularly at the long end of the yield curve. And that's reflecting bigger spending by governments and also a stronger recovery. And I do think that's going to weigh on valuations. And probably the third thing that worries me, which we just discussed in the last answer, is really the impact of these virus mutations and the new strains, and how much that is really going to jeopardise reopening, therefore, positively or negatively impact the earnings rebound that markets have expected. Now, markets are pretty much priced for perfection, so any kind of delay or weaker recovery at least does have the potential to drag down stock indices, in 2020.
Matt Sherwood there from Perpertual. Now the Australian dollar hit a fresh 3-year high today, breaking 79 US cents, and it's now up around 38% since the low point reached in March last year against the US. So for more on that, I spoke earlier with Craig James, the chief economist from CommSec. Craig, the Australian dollar breached 79 US today. Why, and what does it say about the economy?
What we can put this down to is a wave of optimism across the global economy and also about the domestic economy. If we think about the situation globally, what we're having is more vaccinations occurring and fewer cases of COVID are occurring as well. So we're seeing an improvement in the health situation. That's leading to prospects that we'll start to see an opening up of global economies, and that will be positive, certainly in terms of demand for a range of commodities, particularly energy commodities, but also with the opening up, that's positive in terms of infrastructure spending, and that means spending on things like iron ore and coking coal, which is the makers of steel. When we think about the domestic economy, also what we're seeing is continued improvement in the domestic economy and a degree of hope that we'll continue to go down this path because of vaccinations. What we're seeing is the range of commodity prices at the highest levels that we've seen in the order of 9 years. So optimism breaking out all over, globally as well as domestically. The Aussie dollar, the highest levels that we've seen in almost 2 years. You have to go back to April 2018.
So do you think the Reserve Bank will be concerned about the level of the Australian dollar?
Well, certainly the current rise in the Aussie dollar is based on fundamentals rather than speculation. We're seeing improvement in terms of global economic situation. We're seeing an improvement domestically. We're seeing commodity prices rising as well. So what the Reserve Bank will basically just be more entertained at doing is keeping the interest rates at low levels to ensure that our currency doesn't become too high.
Craig James there from CommSec. That is SBS On The Money for this Monday, the 22nd of February. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.